Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning or good afternoon, depending on where you are, and welcome to Develop Your Edge with Anthony Crudele. I'm your host, Michael Burke, filling in for Tom Schneider, who's on vacation this week. It's Thursday, August 3rd. Anthony, fantastic to see you again. We haven't done this for a while.
Yeah, great to be back with you, Mike. I'm excited for today's show because I know we're going to talk about blow-off tops, but this also fits into a blow-off bottom, and it doesn't necessarily mean blow-off long big picture top or long-term big picture bottom. We're just looking for blow-off tops and blow-off bottoms and how we trade them.
So let's start off with, what is a blow-off top? I think that's the question of the day.
And so the way I look at, I guess it's going to be dependent on what your time frame would be, right? I think a lot of people right now are talking about the big picture blow-off top because we've had such a rally. I've heard from a lot of macro experts on my futures radio show talking about the possibilities of a blow-off top where, we just continue to build up the short positions. A lot of people have been talking about the COT data, and maybe you get a blow-off top and then the market comes back in and maybe as to what most people think is mispriced, and maybe gets priced back to what some people may think it should be priced at. But I don't look at it from that big of a picture of a perspective. I think that it's too hard for my mind to wrap myself around a big picture top or a big picture bottom, because in my 25-year career, I've never caught one on one side or the other. It's always about just executing for what the day is. And if you just so happen to be participating in a time where the blow off top or the blow off bottom happens, great. And so I'm just going to put together some rules and some structure that you can put into your trading to help you execute, a blow off top or even a blow off bottom.
That's fantastic. All right, so let's get started.
So let's talk about the things that I look at when looking for blow off tops or blow off bottoms. For the blow off top specifically, I like to look at a very short-term moving average, a 5-day moving average. We're going to look at it on the daily chart. We're going to look at daily Bollinger Bands, 20-period, 3 standard deviations, and then we're going to go intraday, and we're going to look at order flow accumulation, cumulative delta, and then we're also going to look at the order flow VWAP. And I take this basically from that bigger picture all the way down to the execution side of things. Once again, here's the chart deck that I have for all of you. It's available at anthonycrudele.com/chart decks. You guys can go there and download it. It's free. It's just to give you a review following Develop Your Edge of some of the things I discussed. And when you look at the 5-day moving average, and I'm not going to just read this verbatim here, but understand why you look at a 5-day moving average. The reason is because anytime a market is in a grind mode up, what happens is you get a lot of people that are trying to fight the trend, and you build up short positions a lot of times. And also you have just this trend where a lot of people don't want to buy into it until kind of way late, right? And so you're like, oh, it's just staying above this simple 5-day moving average. How much of an impact could that matter in the scheme of things? And it's just really giving you a good source of how tight and how strong the trend is. So the 5-day moving average is important from that perspective because people are trying to fade it, coming back down to a 10-day or a 20-day moving average. You have a lot of people that don't believe in the rally because it just seems too strong. And then all of a sudden you have potential for FOMO. So 5-day is the first point that I look at. Next, I go to the 60-minute Bollinger Bands. And you all know, if you've followed me at all, if you're brand new to the show, obviously welcome to Develop Your Edge. But when I look at Bollinger Bands, 60-minute is my go-to, and I talk about quadrants. I talk about drawing a Fibonacci retracement with a 70, 50, and 30% lines, and they're not your traditional fibs. That's what I use. And you're going to get 5 lines. You're going to get the top peak, which is 0 or 100, depends where you draw the line. You're going to have 70, 50, 30, and then the bottom peak, which is going to be 0 or 100, depending on where you draw it. And so within those 5 lines, I use those as support and resistance. I use the peaks as the potential support or resistance for where a blow off top or bottom can go. And within those 5 lines, you have 4 quadrants. So if you have 5 levels of support and resistance, within there, you have 4 boxes, and I'll show you that on the chart as well. Next, we're going to go to the session VWAP for intraday entries. I like 3-minute opening range. I've done a ton of videos on this. I'm sure you can find them on NinjaTrader's site. You can also find them at anthonycrudele.com, where I've specifically went into this. But really, all it is the 3-minute opening bar, regular trading hours only. You're going to look at the first 3-minute bar. You're going to draw a horizontal line on that high, on that low. And if that VWAP gets above or below that high or low pinned to the opening 3-minute bar, that'll tell you the potential for a trend day. And then I look at that and just say, look, if we stay above that VWAP, I'm just long or I'm just short, and I don't think too much about it. A lot of what you guys will notice from me and Develop Your Edge is do your homework, know what you're looking for, get into the day, long or short, execute. That's it. And so when it comes to the things that we're going to look at today, when we go to the charts next, that is the setup.
Yeah, that sounds good, Anthony. I think everybody watching really needs to see that visual, because I think the idea of the 70, 50, 30 is very innovative, especially since you're drawing it on the Bollinger Band. So I think people really need to see that to grasp that concept.
Yeah, and so let's go to the charts. I know that we saw them there just for a moment. Here's what I look at. Here's where everything starts. So the 20 period 3 standard deviation Bollinger Bands. I don't have the middle Bollinger Band. As you can see, this blue line wouldn't be the middle Bollinger Band because it's nowhere near the middle. So it's just blue, and it's a 5-day moving average. So we start with the daily chart. Pretty simple, right? And what are we doing what are we looking for when we're looking for a potential for a blow off top or a blow off bottom? As I mentioned, until the market makes peaks, and then I have quadrants, I want to see where we are relative to those quadrants and what those quadrants represent. So here you can see 0, 30, 50, 70, 100. And some of you may draw the fib from a different place, and it might be flipped. It might be 30 here, 50, and then 70. It doesn't matter. It's just showing that equal distance apart is all I'm looking for. So it's still, if you're seeing in the top quadrant, you're in the top 30% of the distance of the Bollinger Bands. If you're in the bottom quadrant, you're in the bottom 30%. And so what does that mean? Getting to Mike's point, having a visual of what this is. So what I look at is, remember what I said about the 5-day moving average. It's that squeeze moving average. We're grinding up. Everyone's like, oh God, if you're long, I always say my portfolio is usually doing really good during that time. And my futures account is probably fluctuating quite a bit because I'm probably, struggling to find great entry points because it's just a grind. And so number one, I know that frustration of that feeling. So that's why I like that 5-day, just a good representation of trend. Then you go to the Bollinger Bands. Is the mouth of the Bollinger Band open? Is the Bollinger Bands coming in like what they are right now? And what I look for is when the mouth of the Bollinger Bands closes like it does now, what it means is that the Bollinger Bands temporarily took a breath and they're starting to come back in. They're reverting back in. So remember, when Bollinger Bands are expanding, that means that what? Volatility is expanding. The market's moving in a direction and the Bollinger Band is trying to keep up with price. Right? It's trying to say, okay, here's a 3 standard deviation move to the top. Here's a 3 standard deviation move to the bottom. And so the Bollinger Bands are playing off of what the price action is. So in a sense, it's somewhat of a delayed indication of it because it's trying to keep up with it. And what happens is the Bollinger Bands will then react to what happens to price as the bars close and we go in from one day to the next. So once the Bollinger Bands close on the daily, the first thing I'll look at is, okay, where are we within these quadrants? If we're within this second quadrant from the top, as if we would be just maybe the prior day, that tells me in this area, that's the mean reversion trade. I've talked about this in previous shows. That just means that I'm looking to potentially short off of this line down to the 50% line. When we pull below the 50% line, that tells me that, okay, we could be starting to come back down into support, which right now would come in at 44.70 for me, based upon the daily. And in this area, I have to be careful. I really want to maybe be looking at short on the 50% line down to the 70%, but more likely to buy at the 70%. And so we're just in these middle boxes. So as you can see, my mindset is could be short, could be long, but it's two-dimensional. But if we're above the 30% line, that means that we're very bullish. And that would mean that if we're above these 30% line, above this 46.11, that tells me that the market is in that top 30% and potentially looking to get that peak of that 3 standard deviation Bollinger Band when the market was moving. Think about this for a second. The market doesn't go in just one direction the whole time. And a lot of times blow off tops will come after the market takes a little breath. It tries to mean revert. It'll build up some shorts. It'll get some longs out and then bang. So if you think about it from that perspective, if we were to get above a 30% line in that situation, that would mean that the market is so strong that it can't even get into the bottom 70% of the volatility based upon the Bollinger Bands. And that top Bollinger Band peak, that peak stopped when the market took a breath. And so that is an area of interest to me. That means that the market was projecting a 3 standard deviation move at some point. That was the highest projected point from the Bollinger Band. Let me say that again. That was the highest projected point of the Bollinger Band. So if we get above within that top 30% quadrant, now we're looking at it saying, whoa, that becomes a possibility. When you look at a daily chart here, just going back even a month or so, you don't see a test of a 3 standard deviation Bollinger Band. It rarely happens. And that's what you want, right? You don't want a scenario. This is one of those scenarios that doesn't happen often. And so therefore, if we get into this top quadrant, I'm saying, whoa, we're above the 5-day moving average. We're in the top 30%. This puppy could squeeze and blow off to this top projected peak of 47.16. So that's how we look at it from the first moment. This is the first thing I look at. I don't know if you have any questions about that, Mike. I knew it threw a lot in there, but there's a lot of thinking involved in this.
So just from a tactical point of view, you would be looking to get long above that 30% level. Perhaps you'd be looking to get short below the 70% level. And then in between those times, you're playing the pullback.
Correct.
Yeah.
Because basically, if you look at a Bollinger Band, I figure the way that this is done, and I've pulled statistics on this, when you're in these middle 30 and 70%, you're going to see a lot of mean reversion. You're going to see a lot of back and forth, right? And so I use that box as my edges, 70% and 30%. 50% is not really a line that I use too much. It just shows me that, we're actually in the bottom 50% of volatility, which means I want to see pullbacks that I have to be careful of. But if it could hold that 70%, we probably remain within this area. If we get below the 70%, we could be looking for a blow off bottom. Right? Because once we get down below here, what happens is that, the market is saying, if we were to get below 44.70, we are all of a sudden getting really close to what that peak was projecting, and we could somehow see that. And so that's where the squeezes come. So I look at those as like pressure points.
Yep. So what's interesting, with Bollinger Bands, you're talking about expanding and contracting. Often, they'll contract, and that contraction can be an inflection point, right? The market really doesn't know where it's going to go next. It might continue on. It could be the pullback and go on. So do you often look for that contraction to stop and watch for the expanding to help you really get a bias for the market?
Yeah, the contraction and the expansion is so important because look at right now. I mean, mean reversion happens when volatility most of the time is contracting, right? If volatility is expanding, the move can go further than you think. Because and if volatility, and I shouldn't look at it as really fast volatility, I can look at it as expansion of range. So that's what Bollinger Bands help me. So it's not what you would consider volatility like the VIX. when the mouth of the Bollinger Band is open, it doesn't necessarily mean that volatility is expanding in a rally in terms of the way you look at the VIX as the volatility index. It just means that the expansion possibility of range is of higher probability. But when the Bollinger Bands are pointing in, it means most likely it is going to be hard for the market to expand out of the range. A lot of time the volatility exists within the range.
Yeah, often we see consolidation. Often we see lower volatility. I think the Bollinger Bands contracting are a great way of kind of anticipating the fact that the market may have whatever the trend was may have stalled a little bit. The market's taking a breath, and now we're waiting for the market to tell us what's coming next.
Exactly. Now let's take it down to the next time frame here, and this is where the execution for me really takes place. On the daily, going to be a little bit too hard because I'm not going to just be sitting with a whole bunch of E-minis, overnight to try and trade a blow off top. Majority of the action is going to happen during the day. Same with the blow off bottom. So what I look at is the same exact philosophy on the 60-minute, and the 60-minute is my guide. The daily sets the tone. The 60-minute is my guide. When you get to the 60-minute, where are we relative? So what's interesting is today you see the 60-minute with the peaks couldn't get above that morning 30% level, and the market continues to push lower. What would be considered in the execution of a blow-off bottom? So today, when we get to the charts, we'll take a look and see where that VWAP is. But a blow-off bottom on a 60-minute comes in around 44.99. Let's go back to the daily really quick. The daily, I have supported 44.70. Okay. They're not coinciding. Don't love it to step in for a long until we were to get near 44.70, but 44.99, basically 4,500. That would show to me that if we were to get down there, that could be somewhat of a, I don't want to say a blow off bottom, but it would be in the short term for an intraday look that if we started to get below that, we could head to the daily. But if it went down there and just clipped it and bounced off of it, I would say in this 60-minute time frame, we've achieved enough for the day. So I would be looking short for that to be in that area based upon what the 3-minute is. We'll get to that next. But that would be where I would look for the covers. Now, something that's interesting that could happen is this. Let's just say that this bottom Bollinger Band starts to expand outside of this 4,500, we'll call it, make it easy, right here. See how the bottom Bollinger Band is now equal to the peak? So what this tells me is what? Volatility might be expanding intraday. If we start to push down there and the mouth of that Bollinger Band is open, that to me opens the door to 44.70. Because we are now breaking out to the downside, I would only be looking short. So let me just rephrase this again to make sure I'm clear. Initially, 4,500 area would be support, as long as the bottom Bollinger Band stays above that peak. But if that bottom Bollinger Band starts to push below that peak on a 60-minute, it is opening the doors to a potential of a blow-off bottom type scenario where we would start pushing down on the daily numbers. So it's my guide. That's why I said daily is the tone, 60 is my guide. And now let's go to the shorter term, because this is where really it's going to help me execute. And so I've talked about, let's pull our horizontal lines. You could just hit F6 if you want to do this on Ninja. I'm just doing it right here just to show you. I'm just using a horizontal line. And when you click on it like that, so what's interesting about today is it wouldn't indicate short to me. And I'm going to explain why. So we're looking for blow-off tops and blow-off bottoms. I know that the title's blow-off tops, but we're more near a blow-off bottom than we are at top at this current moment. But what you look for is if we're below, if this VWAP would be below or above the 3-minute opening range high or low, that would be where I trail my stop. I'm just in and just trail it. So if we go back to the daily sets the tone. The 60-minute is the guide. The short term tells me what kind of a day is it? How do you manage your risk? And when the 3-minute opening range is boxed in with the VWAP basically in the middle of it. As you could see today, the VWAP is in between the 3-minute opening range and high. That tells me it's a two-way tape. It's not a trend day. So it's going to be very difficult for me as a trader to execute any directional move. Because remember, blow off tops and bottoms come in trend days. They come in grind days. They don't come for days that's set up for two-way tape. Today's setup is two-way tape because the VWAP is not outside the opening range, opening 3-minute high and low. And I want to quickly touch on this before I go back to Mike. Why is this what sets the tone for me on this? Think about it this way. The bell rings in a fight. You go in to the fight. Any of you have watched UFC or boxing, you go back to even Mike Tyson's a great scenario for this. Majority of those people got knocked out either early in the rounds or way later in the day. But in the initial early in the rounds is when the adrenaline's the highest and the majority of the punches are going to be thrown because that's when they're the freshest. That's what they're coming in looking for the knockout. When you look at opening in the futures market, when the stock market opens, the cash open, that's when the most energy comes to the market. That's when people are stepping in and all the stocks are open and all the energy comes into the market. So you take that from an energy source, and as that VWAP goes out, I want to see it get above or below that opening 3-minute bar to determine who won the opening 3 minutes of the fight. And if you look today, nobody has won that fight. We're basically right where we started. So what does it mean? It means that the market is balanced. It means that the volume is pretty much balanced. Does that make sense, Mike?
Yeah, that makes perfect sense. And I think it goes back to something that we've talked about in this show over and over again. And sometimes it's okay not to trade. You don't have to trade every day. And by following, a methodology that kind of tells you where that direction is going, it can help you it can help avoid getting into a bad trade.
Exactly.
Or a bunch of small losing trades.
To me, today's a day where, we're not going to get into this, but it's a day where you're always reverting back to the VWAP. You're above it early, come back down to it. You're below it early, it comes back up to it. And what do we look for? So I want to go back and I want to do just a real quick explanation of blow off top, blow off bottom from one step down, because I know I threw a lot at everybody and I think a quick review makes sense. Let's start with the daily. Going to look at a blow off top. If we're above the 30% and we're above the 5-day moving average, looking long only. Number one, that sets the tone. If we're looking for a blow off bottom, we're below the 70% or 30% down here, looking short only. Sets the tone. Right? Got to be below the 5-day moving average as well. Come to the 60-minute. Where are we on a relative basis? What I want to see is I want those 60-minute Bollinger Bands open. I want to see potential range expansion on Bollinger Bands. I want to see us below the 70 or above the 30, looking very similar to what we're seeing on the daily, right? So like right now today, we're not seeing any of that happen. We're in between on the daily, but we're below the 30 or 70% intraday. So it's not signaling a blow off bottom type scenario, but this is what's your guide. And you say, okay, let's see if it would indicate short or long. Then you go into your order flow VWAP, and is it set up as a trend day or a sideways day? And that's it. And once it's above or below that VWAP, I'm just long or short. I'm going to use any way that I can to best execute that. And what I do is I'll use for the E-minis, I'll use E-minis and micros, and I'll trade bigger, obviously, in the E-minis. But in the micros, I try to always keep a trailed core position. So I'll try to size up my E-minis, and then I'll just keep that core position in the micros, because the minis I'll try to get aggressive if we hold the VWAP, and then I'll keep really tight stops on larger positions. And the micros I'll be a little bit more lenient with it and maybe move it one standard deviation away from it. So I'm constantly in the market, but I'm adjusting my position sizing. Position sizing is key when you're trading blow off tops or blow off bottoms, because most likely you're going to have to be in somewhat of a reasonable size position relatively quickly once it were to get above or below this opening 3-minute range, and we're below the VWAP. And so you have to be able to withstand it. And it's hard to stomach that. So I like to do E-minis and micros, keep a core, and try to get somewhat aggressive with my bigger positions, and just keep it until it reaches that peak on that daily. And so that's what it is, to summarize it.
Yeah, so it's always a balancing act to put on the correct size, but giving it enough room with a stop loss so that you don't get blown out too early on that trade. That's always a key. That's always a key balancing act.
Yeah, I can't tell people enough on the micros. Look, I really don't use the micros for the E-minis that often. I think they're a great tool for S&P traders, new S&P traders, and you can still trade them as big as the E-mini. You obviously have to do as many a lot more contracts. So therefore, if you're getting into multiple contracts, you want to move to the E-mini. But it's great for times like this, keeping a core position. I can't stress enough that it's just, I look at that position, I put a little bit of a wider stop, I'm able to just hold it, right? And with multiple contracts in the micros, it's sometimes those smaller positions will end up making me more money than even the bigger E-minis, because I might get chopped up trading a little bit with too much size and the market might get choppy. But you ultimately, to me, you got to choose the right product for the setup. When you know you might have some volatility and you know that you have a situation that you want to hold it, just be small enough to be able to stay in it. I mean, that's the game, man. You got to be able to withstand it. And sometimes, most of the time, a lot of us trade too big for the situation and it doesn't work out, and you end up being right in your whole thought process and you end up losing money. I've been there.
Yeah, that's true. We've all been there. Anthony, we're bumping up against our time. Anything else you want to cover here before we go?
I think we're going to do the SDYE, but while we pull up that SDYE, I want to pull this up real quick, just because this is really something that CME has done, and I think it's fantastic. In September, they're going to be adding another challenge, and you can see this link. It'll be in the DYE description on my YouTube channel and on my website, and it's just Battle of the Bonds Interest Rates Trading Challenge, September 10th to the 15th. Why am I bringing this up today? Most of you, I would bet probably 99% of you watching this today don't trade interest rates, don't understand the bond market that well. And to me, if you're in this environment with Fed and everything that's going on in the world, you could go in and trade in a challenge where they're giving away cash prizes and actually give you some skin in the game to learn about the bond market and interest rates and see how they trade. I think it's a great way to learn about a market that maybe you never trade, but you know what? Maybe you like it. I know that the simulation, sometimes you're like, you know what? This is boring for me. But if you're competing for real money, I think it gives you an opportunity to learn about the interest rate market. So I would sign up for that at cmegroup.com.
Yeah, I got my email invite yesterday for that challenge. I definitely look like I definitely think I'm going to join this one.
Awesome. And so now I think we got Ask DYE. So Jace, let's see what that question is this week. Can you read the question, Mike?
Sure. Hold on a second.
I got it now. How do you trail your position in profits?
There you go.
And well, you know, actually, let's go back to the chart. And so let's go back to this. All right. For me, it's always going to be dependent on the trade, the setup. So there is no black and white that I use for each and every single one of them. A majority of the time, I will say, I use standard deviation lines around VWAPs. If it's a trend day, which today is not, I would be one standard deviation outside of the VWAP, opposite of my direction. And it would always be one standard deviation closer to the market as we moved away from the VWAP. What do I mean by that? Hypothetically, right? Let's just say I'm long on a trend up day. We're above the VWAP and we get to the second or third standard deviation and I'm still in the market. My stop would be one standard deviation outside of that. So my standard deviation, so let's just say we're at the 2 standard deviation. I would put it just below the 1 standard deviation and I would move it up like that. Because to me, it tells me how strong of a trend day it will be. If it's a range day, a little bit different. If it's a range day, I look at today, I'm not going to trail stops very far at all. I'll go up to the area. If it doesn't get above 1 standard deviation, almost immediately, I move my stop almost halfway or 3/4 of the way from the VWAP to the standard deviation. You with me? So like, I don't want to see the market go up to one standard deviation right now. If I'm long S&P at 19, or it goes up to one standard deviation is 45.18, 88, which is 44.19. If it goes up to 44.19 and I'm long, I'm going to put my stop in at 17.5. Because why would I give it any more? Because most likely it's going to go back to 15 quarter. How much you want to put yourself through? There's probably going to be more opportunities to get back in. So on a day like today, I'm majority out at support or resistance, depending on what you're using, with much tighter stops. On trend days, it's different. I try to stay in with a bigger position and try to hold it. Once we get 1 or 2 standard deviations above, I start moving it up and I let it get me out because I've got a bigger position on looking for a wider target.
Yeah, that makes perfect sense. That a day like today is tough to trade.
Yeah, I mean, today there's no way. Wherever you trail your stop, they'll probably get it.
Yes.
So why give them more?
They're waiting for you. All right. So Anthony, this has been great as always. Everybody, you can find Anthony on social media, Twitter, YouTube, Instagram. How else can viewers keep the conversation going, Anthony?
Just add Anthony Crudele on Twitter. You can go to anthonycrudele.com. And something we didn't talk about on the blow off top, and I probably will talk about this more on the Place Your Trades network. It's placeyourtrades.com. It's using event contracts. Great tool for a daily option. It's available if you have NinjaTrader. Of course, it's available on Tradeovate, and we're live trading there all the time. And we've got some cool things coming up there at placeyourtrades.com, so you can find me there as well.
Outstanding. Great presentation as always. Thanks everybody for being with us. I'll be hosting Bars Closing today at 3:15 Eastern Time. Have a great trading day. Good luck in your trading, everyone. Thanks, Anthony.
See you.